we're at a very uncertain time, given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact to slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization. I think you have to expect that activity levels are going to be more constrained in a tougher economic environment.
As global inflation reaches multi-decade highs, central banks across the world have taken an extremely aggressive stance against it, with the Federal Reserve boosting its benchmark interest rates by 2% in only 6 months. This rate hike cycle is considered the fastest in history, as this increase is nearly twice as fast as the rate hike cycle of the 1970s, the decade to which we compare our current economic scenario to. What's the reason behind this aggression? The current levels of inflation in the US have gone far beyond their target level of 2%. Given that the nature of this hyperinflation is solely the unemployment benefits received by citizens during the COVID crisis, as money was pumped into the economy without any productive growth in return, this one-sided increase in supply has created a huge bubble that is getting out of hand. And purely interest rate hikes cannot solve this. Instead, they only worsened the situation globally. The current rate hike cycle has highlighted many weak spots in the world economy. This will result in many bubble bursts all over the world, which will be much worse than the 2008-9 crisis. So let's explore these one by one. And if you wish to skip to any point in the video, just click on the timestamps in the description below. Money fuels the global economy. So when the cost of money, that is interest rates, rise significantly, growth suffers, paving the path for a recession. This is exactly what we are witnessing right now. Timing is key when it comes to monetary policy. The economy must be strong enough to withstand the increase in costs caused by the rising interest rates. Along with growing borrowing costs, rising inflation, including rising wage inflation. And this rise is the most harmful type since it never goes away, even if overall inflation levels decrease. For example, if your pay rises from Rs 50,000 per month to 60,000 per month due to wage inflation, it is doubtful that it will fall back to Rs 50,000 regardless of how much inflation levels fall. So the employers have to undertake layoffs in order to balance off the rising costs. Currently, the Federal Reserve has knowingly taken this trade-off and chosen to keep fighting inflation by increasing the interest rates, even if it means that unemployment levels increase from 3.7% to 4.4%. which is roughly a loss of 1.2 million jobs in the economy. The true levels of unemployment in the nation have not yet been captured by these statistics, with people migrating back to their native countries after 2020 and never coming back. The US's actual labor force has decreased. Due to the fall in the denominator and the increase in the numerator, the calculation of the current statistic is distorted. In such a case, the current unemployment rate does not accurately reflect the situation. The housing sector is the most sensitive to increasing interest rates. Over-leveraged housing sectors around the world will be the final victims as central banks around the world go on a mad spree to raise interest rates. The residential as well as the commercial real estate markets are seeing about a 20% fall from their peaks, partly due to a cool-off from their extraordinary rise during the 2020 to 22 period and partly due to a decrease in demand as recession fears gloom the market. The first signs of this were seen in China when Evergrande, the world's most indebted company and China's second largest real estate developer, defaulted on their offshore loans, causing jitters across the globe. Many development projects were halted as a result, and the bond values of all major property developers, including Evergrande, plummeted. Now that Russia has cut off its gas supplies to Europe just before winter, the enormous spike in energy prices on the continent has only increased the economy's inflationary pressures, making them the first victims of recession. Since the 2008 financial crisis, the ECB has gradually lowered the key interest rates to 0% in order to promote economic growth. This caused a property boom across the continent as borrowing costs were low and there was a huge shortage of rental properties. As we look at this chart, the interest rates on the outstanding mortgages are rising as a result of the central bank rate hikes, with a very vivid uptick being seen in the interest rates of Norway and Sweden. In the second chart, we have the housing prices in 4 of the most high-risk countries on the continent. Sweden has witnessed a very steep fall as compared to the others. and the third chart shows the country-wise percentage of overvaluation and undervaluation of the properties in the Eurozone, with Sweden topping the chart. So we can conclude that Sweden is the one that will be the leading country when this bubble bursts, and that is exactly what has happened. The country saw almost a 250% rise in its home prices in the past 2 years. Before the latest crisis, their mortgages and consumer debt as a percentage of their household debt stood at 200%, which is double that of Germany. Now this hollow growth has been exposed due to rising interest rates as their EMI payments have increased, and an over-leveraged middle class now faces the prospect of not being able to afford to pay their mortgages on time. On the other end, the number of corporate bankruptcies have also increased to their highest level in January as the rate of home construction falls and cost of borrowing to finish off their existing ones increase with a simultaneous fall in demand, hence creating a vicious cycle that has sown the seeds for a deep collapse in the housing system in the coming months and years ahead. Thanks for watching part 1 of this video. Stay tuned for part 2 where we'll explore the commercial real estate bubble as well as the ongoing banking crisis in the US. Don't want to miss it? Hit that subscribe button to be notified when we release our part 2.